As we look at the charts right this second, GameStop stock, ticker symbol GME, is trading at exactly $23.10, showing a slight intraday push of about 0.74% in what has been a relatively choppy, low-volume morning session. If you are watching the order book, you will notice the price oscillating in a very tight channel between $22.90 and $23.25, reflecting a market that is essentially holding its breath. The immediate expectation from the retail crowd, the apes and the momentum traders who have held on for years, is that every single tick upward is the start of the next parabolic run, the ignition of the mother of all short squeezes. However, the reality we are seeing on the screen today is far more calculated and, frankly, far more interesting than just a squeeze play. What we are witnessing is not the chaotic volatility of 2021, but the disciplined, almost suffocating consolidation of a company that is fundamentally changing its DNA from a dying brick-and-mortar retailer into a capitalized investment vehicle. The market makers are keeping this in a stranglehold, pinning the price to kill option premiums. Yet the floor is rising. The expectation is that GameStop is still just a video game store trying to sell used discs in a digital world. The reality is that with over $4 billion in cash and practically zero debt, the stock you are looking at today is effectively a special purpose acquisition company, or SPAC, that is already public and has a massive, loyal shareholder base. This disconnect between the bearish thesis of a failing retailer and the bullish reality of a massive cash pile is where the opportunity lies, and it is exactly why we need to strip away the noise and look at the raw mechanics of what is happening right now. Let's talk about the common ground that most people stand on when they discuss GME. The general consensus, especially if you read mainstream financial news or listen to the talking heads on cable TV, is that the stock is completely detached from fundamentals. They will tell you that the revenues are shrinking, which, to be fair, they are, with sales dropping roughly 20% year over year in the recent quarter, and that the business model is obsolete. They compare it to Blockbuster or Radio Shack. That is the safe, comfortable narrative. But here is the contrarian take that forces you to rethink the entire thesis. Profitability for GameStop is no longer about selling video games, it is about interest income and capital allocation. When you have a cash pile that large sitting in short-term treasuries, you are generating tens of millions of dollars in free cash flow just by existing. The company posted a profit not because they sold more consoles, but because their balance sheet is a fortress. This shifts the valuation model entirely. You're no longer valuing a retailer. You are valuing a holding company run by Ryan Cohen. If you are judging this stock solely on its ability to sell Funko Pops, you are missing the forest for the trees. The stock isn't moving today because of game sales. It is moving because the market is trying to price in the option value of what Cohen will do with that war chest. Analyzing the recent movement over the last few trading sessions, we see a distinct change in character. Volume has dried up significantly compared to the mania of previous years. We are seeing days where the stock trades less than 5 million shares, which tells us that the liquidity is getting thinner. When liquidity thins out, it takes less capital to move the stock significantly in either direction, which explains the sudden $2 jumps and drops we see out of nowhere. This is often a precursor to a larger move. If you are tracking the institutional flows, you might notice that the selling pressure from major funds has largely exhausted itself. They have either exited or they are hedging. The short interest remains high, but it is nowhere near the reported levels of 2021. Yet the hidden short interest through swaps and ETF baskets like XRT remains a major point of contention and analysis. We are seeing the stock respect the $20 level as a hard floor, a zone of immense support where buyers step in aggressively. Every time GME dips below $21, the buy orders flood in, likely from retail investors dollar-cost averaging and from algorithmic traders playing the range. On the upside, $30 remains the psychological and technical barrier. Breaking that level with volume would likely trigger a gamma ramp, where market makers hedging their call options are forced to buy shares, driving the price even higher. Now, let's widen the lens to how you might be interacting with this stock depending on your platform, because this actually matters for market structure. If you are using Robinhood stock trading, you are likely seeing the simplified line chart that emphasizes the immediate percentage gain, which triggers that dopamine hit. The Robinhood app has gamified this experience, and for GME specifically, the user interface acts as a sentiment gauge. When Robinhood Crypto and Robinhood Investments notifications start popping off, we often see a correlation in GME volume, suggesting that the same liquidity pool of younger, aggressive retail capital is rotating between assets. However, if you are using Fidelity investments, you're looking at a different ecosystem. The Fidelity trading platform and Fidelity mobile app tend to attract a slightly more capital-rich, hold-long demographic. We have seen massive transfers of GME shares into Fidelity brokerage accounts specifically to utilize the direct registration system, moving shares out of street name and into the investor's own name. This behavior is unique to GME. You don't see this mass exodus from individual brokerage accounts to transfer agents with Tesla stock or Apple stock or Nvidia stock. It is a specific phenomenon where Fidelity Wealth Management clients and Fidelity ETFs investors are partially ignoring the diversified advice and allocating a specific locked portion of their portfolio to GME. This reduces the effective float, the number of shares available to trade, which makes the stock more susceptible to violent upside moves when demand spikes. Moving deeper into the mechanics, we have to talk about the recent share offerings. The company raised heavily in 2024, selling into the volatility. At the time, expectations were that this dilution would crush the stock price. The reality? The price absorbed the dilution and stabilized higher. Why? Because the cash per share increased. This is the crucial metric. If you are an investor using Schwab Intelligent Portfolios or looking for online investment advice, you are usually told that dilution is bad. But in this case, selling overvalued stock relative to earnings to pile up cash actually increased the fundamental floor value of the shares remaining. It was a masterclass in capital markets arbitrage. The company effectively sold hype to buy safety. Now they have the optionality to pivot. This brings us to the investment policy change that allows Ryan Cohen to invest that cash in other equities, not just government bonds. This is why the Tesla stock and Apple stock comparisons are becoming more relevant, not because GME is a tech giant, but because GME might start buying shares of other undervalued assets. Imagine a scenario where GME becomes a major holder of other undervalued assets. It shifts from a self-investing retail play to a managed fund. For those of you using SoFi Invest or SoFi Investing products, you might be familiar with the social aspect of their platform. The sentiment on SoFi stocks feeds is often a leading indicator. Right now, the sentiment is bored but hopeful. This is dangerous for short sellers. Boredom means the weak hands have already folded. The people left holding GME at $23.10 are not going to sell because of a bad earnings report. They have already sat through the worst. If you look at SoFi ETFs or their SoFi robo-advisor, GME is rarely included in standard baskets, which makes it an idiosyncratic risk. It moves to its own beat. This uncorrelation is valuable. When the broader market, say Nvidia stock, takes a hit due to macro fears, GME often stays green or flat. because its holders are not operating on the same logic as the algorithms trading the S&P 500. This makes it a strange, accidental hedge in a portfolio. Let's touch on the interactive brokers crowd. Traders using the interactive brokers trading ecosystem are often more sophisticated, using the interactive brokers platform to access dark pool data and global exchanges. They are seeing the tape in a way retail traders on other apps don't. They can see the order splitting, the way large blocks of 5,000 or 10,000 shares are routed off exchange to prevent price impact. The interactive broker's fee structure appeals to high-frequency traders, and right now the high-frequency algorithms are treating GME like a stablecoin, scalping pennies back and forth. This suppresses volatility, which ironically coils the spring tighter. Low volatility leads to